All right, let's talk about the Malaysian property market for 2026. Look, this is not your average run-of-the-mill market. It's a landscape of what some are calling a great divergence. And what that really means is you can't just throw a dart at a map and hope for the best anymore. If you want to succeed in 2026, you need a very, very specific game plan. So today, that's exactly what we're going to build together.
So here's our roadmap. First, we're going to look at the big picture, this idea of a market of two halves. Then we'll dive right into the subsale sweet spot. This is a big one. You don't want to miss it. After that, we'll figure out where to look by, you guessed it, following the infrastructure. And we'll wrap it all up with a super simple investor checklist that you can actually use.
Okay, first up, a market of two halves. You know, you might think property is all about supply and demand, right? Well, for 2026, that's really only half the story. The single biggest driver right now, it's government policy. And it's not subtle, it's deliberately creating a split in the market, basically picking winners and losers right in front of our eyes. And this brings us to the one key idea you really need to grasp, the barbell market. Seriously, just picture a barbell. On one end, you've got the affordable market, properties under 500K, and the government is just loading it up with incentives. Then, way over on the other end, you've got the luxury market. And they're adding weight too, but it's friction, it's barriers, especially for foreign buyers. This is a deliberate move, a very clear signal about where they want local money to flow.
So let's look at the nuts and bolts of this barbell strategy. It's basically a classic carrot and stick approach. For the affordable market, for local first-time buyers, they're dangling this massive carrot, a full 100% stamp duty waiver for homes up to 500K. I mean, that's a serious amount of money back in your pocket. But then for the luxury market, out comes the stick. The stamp duty for foreign buyers, it's been doubled to a flat 8%. Yeah, the message here is crystal clear.
So you gotta ask, why is the government so laser-focused on this affordable segment? Well, this one number tells you the whole story. 77.7%. That's the slice of all residential property transactions in Malaysia that are already under the 500,000 ringgit mark. It's huge. The government isn't trying to create a new market here. They're just pouring gasoline on the fire that's already burning.
And you know, what's great is that this isn't happening in a vacuum. The whole economic backdrop is pretty solid. We're talking stable GDP growth, inflation is low and under control, and the big one for any investor, interest rates are expected to stay stable. What does that mean for you? It means your loan is going to be predictable, and financing is relatively cheap. It's a really stable, low-risk foundation to build your strategy on.
Okay, so we've got the what. The government is pushing everyone towards affordable homes. But the next big question is, where does all that demand actually go? And that brings us to the real heart of our analysis today, the subsale sweet spot. This is where things get really, really interesting.
But wait a second, I can already hear you thinking it. What about the massive property overhang? Right? It's been the bogeyman of the Malaysian market for years, and it's probably the #1 thing that makes investors nervous. But we really need to dig into this because the headline number doesn't tell the real story at all.
And here's that real story. See, the overhang isn't a blanket problem across the board. Take a look at this. Almost 60% of all those unsold homes are condos and apartments. And when you dig a little deeper, you find out they're mostly either super high-end units nobody can afford or so-called affordable units built, well, in the middle of nowhere, miles from any jobs or train stations. So this isn't a market crisis, it's a mismatch crisis.
And this mismatch creates this huge headache for the people building new properties. It's a problem we're calling the developer's dilemma. And understanding this dilemma is the key to seeing why the secondhand market is such a golden opportunity right now. Okay, part 1 of the dilemma, developers are getting spooked. They're seeing this mismatch and they're hitting the brakes, hard. New residential launches dropped by a whopping 26%. Just think about that for a second. The pipeline of brand new homes is seriously drying up. And here's part 2. They're stuck in this brutal pincer move. From one side, construction costs are going up. 70% of them say this is a huge problem. But from the other side, nobody's buying. Their sales rate is a painful 24%. So they're forced to price their new homes higher, but the buyers just aren't showing up at those prices. So here's the punchline to this whole story. You've got this massive wave of first-time buyers armed with stamp duty waivers, all looking for a home under 500K. But the developers can't give them what they want. The new stuff is too expensive, it's in the wrong spot, or it just isn't being built. So where does all that money, all that demand, have to go? It gets funneled into one place, the subsale market. People realize they can get a perfectly good home in a much better location for the right price. That is the sweet spot for 2026.
All right, so we've nailed down the what. We're looking for affordable subsale properties. Now for the million-dollar question, where? And the answer is actually pretty simple. Follow the infrastructure. Because in 2026, these massive projects aren't just lines on a map anymore. They're becoming reality, and that's where you're going to find the growth.
And really, there are 3 mega projects to watch, but each one offers a totally different kind of play. You've got the Johara Singapore RTS, which is almost done. That's your high-yield rental play right now. Then there's the ECRL, which is more of a niche, long-term hold. And the big one for the future is the MRT3 in the Klang Valley. That's your classic long-term appreciation investment.
Let's zoom in on the biggest game changer for 2026, the RTS link. And this number says it all. 6 minutes. That's the new commute time from Johor Bahru to Singapore. Let that sink in. 6 minutes. This isn't just a faster train, it's a complete rewrite of the rules for the property market in Johor. And you don't even have to wait to see the impact. We're already seeing rental yields of 6 to 8% for properties near the RTS line. And this isn't a fluke. It's driven by a huge, reliable group of people who can now live in affordable Johor and earn in Singapore dollars. It's an economic no-brainer.
And it gets even better. On top of that fantastic rental income, the properties themselves are expected to go up in value by 5 to 10% a year. So you're literally getting paid to wait. It's that perfect investor combination: strong monthly cash flow and solid capital growth.
Now, if you're playing the long game, look no further than the MRT3 Circle line. Sure, it won't be ready until 2032, and this is the crucial part, construction kicks off in 2026. And if you look at any major transit project, property values don't wait for the ribbon cutting. They start climbing the minute the shovels hit the ground. That makes 2026 the absolute ideal time to get in, and then just hold on for the ride.
Okay, let's pull all these threads together. We've talked policy, we've talked market supply, we've talked location. Now, let's turn it all into a simple, actionable checklist you can actually use.
So here it is, your 2026 game plan in 3 simple steps. First, target the sweet spot. That means you're laser-focused on subsale properties under that magic 500K number to take advantage of all those government perks. Second, follow the infrastructure. This is your where. You're either looking at high-yield areas like near the RTS, or you're planting a flag for future growth near an MRT3 station. And third, future-proof your asset. This is so important. Think about who's going to rent or buy from you down the line. Is it good for Gen Z? Is it near transit? Does it have any green credentials? You've got to think ahead.
And look, just as critical as knowing what to do is knowing what not to do. First, avoid the mismatch trap. Don't get suckered in by a cheap price tag on a property with a terrible location. Second, stay away from the luxury squeeze. That new 8% stamp duty is a real headwind for that part of the market. And finally, be wary of the primary market pincer. New launches right now are often overpriced and come with risks. The subsale market is just a safer, smarter bet.
So, to wrap it all up, the old strategy of just buying any property and waiting for it to go up, that's over. As we've seen, success in 2026 isn't about buying anywhere. It's about buying precisely where policy, infrastructure, and demographics all collide. You find that sweet spot, that intersection, and you've found your path to success.